This is the exact trading strategy I used to get funded and make $10,000 my first month trading. Today, I break it down step by step, no fluff, no overcomplication, just exactly how I trade. Let's get into it. Before I start, I'm actually giving away $1,000 in Bitcoin from today's trade. All you have to do is like, subscribe, and comment down below, and I'll pick one of you guys in the next video. I'm doing this as a thank you for taking the time to learn and leveling up your life. I've tested and refined this exact trading strategy every single day for over a year now, and it's the exact strategy I use every single day. Most trading videos make this way harder than it needs to be. Indicators stacked on indicators, complicated rules, and no clear execution plan. I trade clean price action, market structure, and fair value gaps. The goal isn't perfection. The goal is stacking probability and executing consistently. I'm a futures trader. My primary asset is gold, but what matters isn't the symbol. It's the structure. This framework is built on how price moves, not on which market you're watching. So whatever asset you're trading, if done correctly and the odds are in your favor, this strategy could get you funded. Before we get into the technicals, I want to give context on who I am and why this strategy matters. My name is Alex Films, and I spent close to 8 years building a creative agency from the ground up. During that time, I worked with real clients, managed real money, and built real capital. A little over a year ago, I took that capital and shifted my focus over to trading. Since then, trading has become my primary source of income, and I've already made more trading than I have my entire time building my creative agency. This is the exact process I use every single day. So get your notepads out and get ready to take some notes. Let's get started. The strategy, I call it the RIZ strategy. RIZ stands for the repricing inefficiency zone, which is the precise zone inside a broader displacement where repricing is most likely to occur. It is not the entire displacement, it is the high interest area where price previously failed to transact efficiently. A RIZ represents unfinished business left behind by aggressive price movement, also known as a fair value gap. All right, now it's time for the process. If you want this entire strategy laid out step by step, I turned it into a free PDF called the RIZ Trading Strategy Guide. Check the description, follow me on Instagram, and DM me the word guide, and I'll send it to you for free. Now, this strategy follows a very simple model. I start with the daily chart, then move to the 15-minute chart, and I execute on the 5-minute chart. Each time frame has one job. I never mix them. Now we're hopping onto TradingView. If you don't know what TradingView is, man, this is the wrong video for you, bro. We're already on the strategy, so make sure y'all get on the right page. But anyways, we're gonna start off with the daily chart. So this right here is where I define my direction, right? I'm not predicting tops or bottoms. I'm asking simple questions. Are we trending? Are we ranging? Are we making higher highs or higher lows, or lower highs and lower lows? And is momentum expanding or stalling? If the daily bias is bullish, I only look for longs. If it is bearish, I only look for shorts. This alone filters a lot of bad trades. But yeah, so we look at the daily right over here. This is the current time frame that we're at right now. So like right now, the moment that I'm recording this video, here we are, right? We go to the daily, we look bullish, very strong bullish, right? Except for the past when we had a rejection to the upside. So now we go to the 15-minute. All right, now step 2, the 15-minute chart, where we define the market structure. The 15-minute chart shows me my market structure. I want to see clean higher highs and higher lows, or lower highs and lower lows. I'm looking for strong impulse moves followed by clean pullbacks. If the structure is choppy, overlapping, or sideways, I don't trade. All right, no structure, no setup. If the structure is moving sideways, another word for that is consolidation. So make sure y'all write that down. That's pretty important. Consolidation, the market is moving sideways. And we don't want that, because that kind of just shows that there's indecision in the market, right? Kind of like this right here. We can see that it's kind of stuck in one area, right? It's moving, or like right here, I guess it's a better choice here. Let me mark it out for you. So right here, we can see that the market is basically moving pretty sideways, right? So right there, we don't want to trade because we don't have higher highs or higher lows that are nice and clean. So we don't trade that. But looking at what we're looking at currently, we do see a little bit of a trend going, actually. So it's actually a pretty good example. So it's actually, it works for right now. But we're on the 15-minute chart. This is where we see our trend, and it looks good. So I actually do see a setup. So let's move to the 5-minute and keep showing y'all the process. So step 3, the 5-minute chart. This is for marking and execution. Now we're looking at the 5-minute chart, right? As we were saying before, this is where we mark and where we execute, right? So this is the most important. I mean, the other ones are still important, but this is where everything, comes down. So right here is where we're going to start marking out our fair value gaps, okay? A fair value gap, get your little pencils out or pens, whatever you need right here. A fair value gap forms when price moves aggressively, participation is thin, and an imbalance is left behind. So an example of a fair value gap would be this one right here. Okay, we see this right here. We actually don't see that it tapped into this fair value gap here, but this is a fair value gap. That's all we're looking for right now for this explanation, a fair value gap, okay? We should actually go back and find an example. So let me go into replay and show you guys a clean example. Back into replay and I found an example for y'all. So we are on the 5-minute chart and this is where we're going to be marking and executing. All right. This is where the strategy comes together. This is one of the most important parts right here. The other ones are important. All right. They're still important, but this is where we mark and execute. So this right here, you have to pay real good attention. So just sit down, just get in here and focus. All right. So the 5-minute chart is where we're going to be marking, right? We're going to start off by marking our fair value gap. And I know you guys can see the full chart, but this is just so you guys can visualize it. But we have one big fair value gap right here. Hopefully y'all saw that before. I already saw it. And we're going to go ahead and mark it. I mark it just like this. Just put a little rectangle, nothing crazy. And then I make the rectangle green, right? Some people have pre-made customs for bullish fair value gap, bearish fair value gap, whatever. I just do a little green rectangle. No big deal, right? So you can do it however you like. But right now we marked out this fair value gap. So let me give you guys some definitions for this, for what the fair value gap is, just so you guys can have something to write down. So at the core of the approach are fair value gaps. A fair value gap forms when price moves aggressively, participation is thin, and an imbalance is left behind. So right over here, price moved very aggressively to the upside. So this was a bullish fair value gap, or that it created because there was more buying power than selling power. So now there you can see there was no long wicks right in between that fair value gap or anything. So it was stronger to the upside. So there was an imbalance. So what we had to do is go back and rebalance all that and refill all that empty space right there that we left, right? So that's where our fair value gap comes in handy, right? And a little note, it might be a little early for this, but I usually sometimes set limit orders for 50% of the fair value gap. So then I can, either if it's bullish or bearish for that. But we'll get into that later. So these areas are unfinished business in the market because price moved too fast and it did not transact efficiently. The market often revisits these areas to rebalance. It doesn't always revisit it, but for the most part, it will. Okay, so how I use fair value gaps on the 5-minute. So on the 5-minute chart, this is where I mark a line fair value gaps, wait for price to retrace into that zone, just like this, right? It retraced right here, right? Boom. And then this is where I prepare for confirmation. So I wouldn't enter right away because it does look choppy right here on this little part that I chose. So it wasn't the best example, but I didn't want to give you this perfect example because it's not always going to be perfect, So we had to have this little bit of chop right here. And this is an area of interest, of course. It's not the entry. So my non-negotiable rule is no retracement into a fair value gap equals no trade. I don't chase the price. And if price runs without me, I let it go because that's just too much of a risk for me. And I don't want to risk that much. So patience here protects your capital. So the key principle is fair value gaps define where I pay attention, not when I enter. Execution always comes later. So an important note is like a little discretion before entry. Here, just get your notepads out again. This is where you need to jot these down. So these rules are filters, not guarantees. 2, a wick into a fair value gap does not automatically invalidate a setup. 3, one missing factor does not always cancel a trade. 4, these rules help me decide when to be aggressive, when to stay patient, and when to stay out. 5, discretion is applied before entering, not after. So remember, y'all need to remember those before entering. All right? Because now we're going to get into that part. So step 6, trade planning. Before I enter any trade, I already know 3 things: my entry, my stop loss, my target. I don't figure these things out after. You got to make sure you have it before, because then if not, that's where things can get blurry and you can mess up. So if I can't define all three, I do not take the trade. My stop loss is placed beyond the rejection structure. So if I were to, enter over here, my stop loss is, I would probably put it right there at the fair value gap, or probably at the past candle low. And that's where my idea is invalid, right? Once I'm in, the stop never gets widened. So that's where my stop loss is, and it's not changing. I'm going to leave it right there. All right, so my targeting approach. There's multiple targeting approaches that you can use. So I use two main targeting approaches. One is structure-based targets, like previous highs, lows, supports, or resistance. So that here's a previous resistance right here, right? And here's a previous high that we had. Again, another resistance, right? Boom, we could see that it ended up hitting that, but basically we're trying to pretend that's not there right now. So this is where we could mark it if you're very confident, but usually when I'm like, okay, I want to make sure I secure profits, most of the time it will hit this previous resistance right here, or this previous high. So if you want to be safe, you go there. And then there is another one. It's daily goal targeting. Some traders prefer a fixed daily goal because it reduces greed and builds consistency. Once the daily goal is hit, trading stops for the day, right? So sometimes, people work 9 to 5. They make $100 to $200 a day, right? So someone probably could be like, oh, my target is $250 for the day, and that's it, which is pretty generous for trading, because trading, you can make a lot more. So just saying, hey, I want to make $250 a day would only be a few points depending on which asset you choose, and it could be safer than targeting these past highs or things like that. So now, step 7, my entry confirmation. I only enter after confirmation. I want to see rejection wicks on the opposing side, 2 confirmation candles closing in my direction, and momentum shifting back in line with my bias, okay? So if we zoom in, we look at these candles, okay? When I would have entered over here is on this, so we had one bullish candle with a rejection wick to the downside. Let me mark it out for you right here. So that little candle, that little bullish candle with the rejection wick to the downside right here, and then this next candle showing, confirming that we're going bullish. So I would have entered on that third candle, okay? And then that's where I would have been comfortable entering my trade. This is right here, basically where we'd start. So let's buy in right here, okay? We're gonna set our take profit right there, and we're gonna set our stop loss right down here at the bottom of the wick of this candle right over here. Right? Oh, that is not where I want it to be. Let's give it the bottom of this wick right here. Boom. There we go. Now that right there is where we'd want it. That's good risk management. Here we go. Let me move this up because that's where we entered. And then this right here is where we'd watch it play out a little bit. Okay. So as we entered this trade, we had our take profit that we marked. We had our stop loss down here already, and where we were going to enter. So all of that's ready. We're not moving anything once we enter the trade because we knew exactly what we wanted when we wanted, okay? So once I'm in the trade, I stop predicting. I manage what I planned. I'm watching momentum continuation, opposing candles, and signs of exhaustion, right? If momentum weakens, I'm comfortable taking profits early. You got to remember that. Some people are not comfortable taking their profits early. If you see this chart start going up, we could start pressing play, right? And we could see it move. Okay, it's doing good. We're up 490. Boom, right there. Let's pause it there, for example, right? Once it starts retracing, people get scared, and that's like it could go down back to break even or lower. So you got to be comfortable taking your profits, but you also got to be comfortable in your take profit, okay? So there's 2 ways about it. If you're really confident in your take profit, you can hold, you can wait. It could retrace to break even, so you could walk your stop loss, which is what a lot of people do. And that's better risk management. I don't really do that unless it's a really big trade. But yeah, that's something that's some risk. That's a risk management tool that you can take. Okay, so just some pointers for y'all. These are my no trade conditions. I don't trade during major news, choppy consolidation, or if there's no clean fair value gap. I also don't trade if my daily goal is hit or if I feel rushed or emotional. Staying out is a position. Y'all got to remember that, because if you get it in and you lose $500, well, if you didn't even trade that day, you would have been $500 richer, basically, because you didn't trade. So you got to remember that. That's also a position. All right. And these are important expectations. So this strategy does not win every trade. Losses are a part of trading. So y'all got to remember that. The goal is consistency over a large sample size, not perfection. Some days the market gives nothing. On those days, not trading is the correct decision, because y'all don't want to lose y'all's evals just because you wanted to trade because you weren't patient. All right. That's something important. But what we're going to do right now is we're going to let this trade finish playing out. We're going to see what it does. Hopefully I hit TP. Okay. Oh, look at that. It's going down and then we're going back up. Okay. See, that's a little scary once it goes up and down. Like, see, we're getting some consolidation. It's choppy. It almost hit my break-even point. Okay, see, now we're underneath. Okay, that's where walking the stop loss would have helped. Okay, because then you would have got profits, right? If you went to break even, you could have at least broke even, or you could have locked in some of those profits. But I sometimes, value where my take profit is, and I let it be, and I trust it. So here we go. Hopefully we see it hit, and boom. There we go. We locked in our trade of whatever that was, 1,000 something. Woo! Y'all, come on, clap for me. Wow, boo. The only reason y'all are booing is because y'all can't pass your dang funded. That's why. All right, see, y'all would have probably clowning on me for not moving my stop loss, but who's the one laughing when y'all can't even pass a combine, bro? Anyway, sorry. I don't mean to clown y'all. Y'all are trying. Y'all are trying to learn. But y'all were booing me. That wasn't my fault. But here was our trade. Here was our example trade. And it was a little bit of a risky trade. I know it was, because we went below our break-even point. But I kind of wanted to find an example like that, because not every trade is perfect. If I go in and show you this trade that's perfectly going to hit the fair value gap and go up, that's not realistic. And on every day-to-day condition, it's not realistic, honestly. You have to be able to show how difficult it actually is day-to-day, right? Because it's not as easy as like, oh yeah, hit that and then just mark your past high and you're good to go. That's it. That's where you take profits. Sometimes you don't hit TP. Sometimes it goes down and you're in profits, right? About to hit TP. Sometimes it'll just wick you, your TP, not even hit it, and go straight down, straight into your stop loss, which sucks, but that's how trading is. That's the reality, and I know it's hard. That's just how it is. All right, that's just how it is, and y'all gotta be ready to do that. I know trading is hard. A little closing statement to y'all. I know trading is hard. Everyone's reason is different. Family, freedom, financial pressure, whatever it is. Remember why you started, because there's a reason you started this, right? It wasn't just to put yourself through pain. It was for a specific reason, to get out of whatever problem it is that you had. So just stay disciplined, stay patient, and don't quit. I'll see y'all in the next one. Let me know what videos y'all want me to do next. If y'all want some trading content or specific trading content, let me know. But yeah, thank y'all for watching. Like, comment, and make sure y'all subscribe. And don't forget about the giveaway. And if y'all want the guide, make sure to hit my Instagram up. But yeah, I'll see you guys in the next video. Peace.